Welcome to the Porter & Company Black Label Podcast, your home for provocative insights that lead to lasting wealth. And here are your hosts, Porter Stansberry and Aaron Brabham.
Porter, it's been a while. We actually did not have a show last month. You had a pretty crazy
I had to go to
travel.
Ireland.
Yeah, exactly. You had a crazy travel schedule. Now, you just beat, Ireland right now, nobody's roaming around because the people are in the street.
Yeah.
You know, they're mad as hell, and that government might be going down pretty soon.
I hope so. That would be really fun.
Too.
That'd be fun to see somebody reject the whole globalist narrative and say, no, whether it's good for our economy or not, we want Ireland to be for Irish people.
Yeah. And if their government
right to
gets
me,
the no vote of confidence and they get, wiped out essentially, that's a warning shot to the other governments. Like, you can't just bully because...
I personally, I love how loose the Irish get.
I do too.
They get loose.
Yes, they do. And I love that.
I think it's great.
Yeah.
I wish we saw more of that in the United States. And if there is going to be a place that happens in the United States, I would love for it to be New York City. So I got to go off on a tangent here.
Yeah, you have first-hand experience with New York City.
I got to rant a little bit. So I moved to New York about 2 years ago. I leased one of the nicest apartments in the whole city. I have a top floor apartment in Hudson Yards. It's a gorgeous place to live. It's adjacent to the train station. I can go door to door from my farm to my apartment in New York in less than 3 hours.
Yep, phenomenal.
And I've really enjoyed living there, except for when I have to leave Hudson Yards.
Mm.
And anytime I have to leave Hudson Yards and I go in the General Pop in New York City, it's disgusting. About half the time I get threatened by a crazy vagrant. I have to smell marijuana everywhere I go. There's trash everywhere, and there's just trashy people on every corner. It's disgusting.
Now, hold on. Since you moved there, have you seen a degradation, or has it been pretty consistent? Like, is it under the new mayor?
It hasn't changed since I've moved there.
Okay.
But it's a huge degradation from how the city was 10 years ago.
Yeah, okay. Yeah.
And if you live in New York, you know exactly what I'm talking about. And the stats, by the way, I'm telling you about my firsthand experience, okay? But the stats also show just how bad things have gotten in New York. The violence is just crazy. Let me get to this highlight. Sorry, I wrote up this yesterday, so I'm scrolling through what I wrote. So, in 2024, there were 10 murders on the New York City subway. That's the most since 2006. Subway felony assaults are up 55% since 2019. You cannot go on the subway at night.
No way.
You cannot. This poor woman, a 40-year-old Deloitte manager, Michelle Go, was pushed to death in front of the R train at Times Square. By whom? A schizophrenic man.
Yep.
There was a slashing just yesterday. Guy tried to kill 3 people, again, at Times Square. What is going on? Well, the answer is they have this whole process where there's about 2,000 people who they know are crazy, and they just keep releasing them back
Catch and release.
onto the street. Yeah.
And then the police lose motivation, obviously, because it's just a recyclable trap.
That's right. So I want to tell you one more thing about cannabis. They legalized recreational cannabis in New York City in March of 21, right in the middle of COVID.
Okay.
Is this a good idea?
Yeah, that seems like the healthiest thing you should do.
So they estimate now that there are about 8,000 unlicensed cannabis shops operating operating in New York City.
That's insane.
The whole place smells like poor trash humans.
Yeah, well,
I'd be more descriptive, but it would get me in a lot of trouble. And the other thing that I want to point out about this is they have a new communist mayor.
Yes,
The first move of the communist mayor, and everyone's celebrating it, we're going to tax the rich, he says.
Mm-hmm. Yeah,
so one of the major drivers of the New York economy is how all the wealthy people in the world like to have a pied-à-terre there, like to have a small apartment there. They like to be able to go into the city, go to the best restaurants, enjoy the city parks, all that stuff, but they don't actually live in the city.
Mm-hmm.
So they don't pay taxes in the city because they don't live there. They do pay property taxes. So it's not like they don't pay anything.
Right.
And they contribute enormously to the economy.
Of course.
All the sales taxes, all the restaurant taxes.
Consumptions.
All the consumption taxes. They're driving the city economy.
Yes.
So what's Mandami sue? He says, if you have a pied-à-terre that's worth more than $5 million, we're going to tax you a huge surcharge on that. We're going to tax the rich.
Yeah, so what happens to those people, Porter? What do they do?
Let me tell you how big the shortfalls are going to be.
Yeah. Okay. Exactly.
So this is what the city budget in New York is actually looking at. The city of New York, just the city of New York, their annual budget is $120 billion. That's larger than the budget of the entire state of Florida, which has 3 times the population.
Unbelievable.
New York City's budget is larger than the next 10 biggest city government budgets combined. The city spends $14,000 per person who lives in New York. $14,000 in city overhead per person. And what do you think is going on with all that money?
Grift, scams, fraud.
Enormous amounts of
That's
fraud.
all that is.
So that's led to a $10 billion shortfall this year. That shortfall is supposed to grow to $12 billion next year, okay? And how much is this tax the rich going to generate? He says it's going to generate $500 million.
It's going to generate
The shortfall
negative.
is $10 billion. Is that the best communist math you ever heard of?
Yeah.
So we're going to drive out all the wealthiest people who drive our economy forward in an effort to raise $500 million, which won't even be a drop in the bucket compared to our shortfall.
Yeah, that seems exactly right.
Disaster.
Yeah, so what's your future like there?
Well, I'm leaving, obviously.
Yeah.
I think anyone who chooses to stay and pay that tax is just supporting a communist, which I think that's evil.
Yep.
So we're out. Just one more thing about New York. They spend $50 billion a year on supposedly educating people.
Oh, come on.
Okay? That's $50,000 a student. That's more than it costs most people to go to college.
That's criminal.
Okay? And how many people in the schools can read?
Not a high percentage, I'm betting.
Less than half of third graders can read.
Then what's the point of school if you can't read?
And by the way, again, I'd be more descriptive, but I get in trouble.
Yes.
If you actually look at the people who didn't learn how to read at home, the proficiency in reading is very close to 0.
Let me give a plug here if you're interested in Porter's takes. He's got an X account at Porter Stands B. At Porter Stands B. You might get some of these stories over there.
I'm a little more descriptive on the X.
Right. Yes.
But so where do you think all the money goes? This is fantastic. How many administrators does the school system in New York City have?
God.
6,000. 6,000 administrators. The New York Catholic school system, that's a private school system, how many administrators does it have for the same number of people in New York City?
A couple of hundred?
24.
24.
They've got 24 administrators.
6,000.
The city has 6,000. What do you think is really going on there? Let me give you one other example. I think they should just start calling the city government the crime syndicate. They shouldn't call it the government. They just call it the mob.
Yep.
Okay, so phase 1 of the 2nd Avenue subway, which you don't even know the details about this, but it's a very small extension of the subway on 2nd Avenue. It's 1.8 miles of tunnel. How much does that cost?
100 million, which would be
$4.5 billion.
Oh, come on. Come on.
Paris, by the way, is not the epitome of economy or efficiency.
Right.
Paris builds their subway for $250 million per mile.
Oh, wow.
We're at $4.5 billion for 1.8
That makes sense. Yep.
That's 11 times the global average. And you'll never guess what happened when they did an audit of all the MTA tunnel project workers. They found that 200 of 900 workers were superfluous, meaning they were drawing wages, but the officials couldn't identify who they were or what they did.
Oh, wow. Yeah, look, America is honestly the most disgusting place of grift and fraud.
No, it's not. It's just, America is better than a lot of other places in the world, but New York City is becoming a failed state. And what I think is interesting, they just elected a communist. He's going to pass all these rules, all these taxes that specifically target the only thing that city has left.
Yep.
So their tax base is so concentrated into the top of the pyramid that basically the whole city goes broke if about 5,000 people leave.
Which they will.
And they're going to leave.
Yes.
So my prediction for you is that in 10 years, New York City looks a lot like Zimbabwe or Venezuela.
Oh, that's sad, man.
It's going to be really sad. And what I think is so incredible is that everyone says, oh, no, that happened to New York. New York is X, New York is Y, New York is Z. No, it happened because New York was the head of capitalism.
Right.
New York was the greatest center of capital in the world. Well, if you drive out all the capital, what's going to be left? Nothing.
Nothing.
Mandami actually posted a video today where he was mocking by name the founder of Citadel.
Oh, wow.
Pointing to his condo, saying, I'm taxing the rich.
Wow.
I'm taxing this guy.
The evil guy up there.
Why would the evil guy keep living there?
No, he's not going to, of course.
He won't.
No, not at all.
All right, that's my rant. Let's get to something that can make money for people.
Yeah, let's do that.
There's a fantastic opportunity to buy one of our long recommended stocks, and we want to tell the public about it. We don't normally give away stuff for free.
That's right.
But today's your lucky day.
Yeah, for sure. And we're going to bring our very own Ross Hendricks, who's been your right-hand man since you started at Porter & Company.
Ross is a very well-known, highly respected energy analyst, and the company we're going to be talking about today is an energy stock, Venture Global. So let's bring Ross on.
Let's jump right in. All right, Porter, we have our very own Ross Hendricks here. Ross, it's great for you to join us from steamy Houston, one of the epicenters for oil and natural gas. How are you, buddy?
I'm good. Yeah, it's great to be here. We are in the hot and steamy period of Houston right now, so it's feeling a little swampy, but yeah.
Well, let's talk about something else that's heating up, which, of course, is the situation in the Persian Gulf and the threats to a whole lot of the world's fertilizer, helium, and liquefied natural gas. As we're recording this, there seems to have been a ceasefire. There seems to have been a ceasefire for the last, 5 or 6 days. And there's reports today of a further ceasefire in Lebanon. So there's certainly a chance that the Gulf in some way or shape or form opens. But I have a feeling that this is going to take a lot longer than people realize. And even if today the strait was completely open, and it's not, there's still, a good, I'd say, 45-day window where there's going to be really severe shortages. And this plays into the spring planting season. You need this fertilizer now. You can't really, July doesn't really help you. And so this sets the table for a very interesting speculation into one of our favorite investments that we've recommended, in the last 5 or 10 years. Ross, you want to lead us off and describe what's unique about Venture Global and what's unique about the opportunity today, given the conflict in the Gulf?
Yeah, exactly. It's, as you pointed out, it's, even if this conflict ends tomorrow and, it's really hard to guess what's going to happen day to day. But the one thing we know for sure is that global LNG supplies are going to be disrupted for a long time. The largest single LNG plant on the earth is the Ras Laffan facility in Qatar, and that's been shut down since pretty much day 2 or 3 of the conflict. And
it's nice that they named that after you, Ross.
I know. Yeah,
it's not spelled that way. It's RAS, but it sounds like it belongs to you, Ross.
It does. I'd love to take ownership of it, although maybe not these days. It's fallen in the crosshairs of, it's one of the facilities that wasn't, there's a lot of facilities right now that are shut down in the Persian Gulf just because they can't get the exports out. But this one actually came under direct attack by some Iranian missiles kind of around the mid-March area. And what that did was it took out about 17% of this facility's capacity. And because these facilities are so complex and so hard to build, it's going to take an estimated 3 to 5 years just to replace that capacity. And even, again, if you say, okay, that's 17% of a facility, that's 25% of global supply, it's maybe not a game changer necessarily, but the fact that you've had that supply offline for now going on 45 days, and even if you were to try to restart things and the traffic through the strait starts flowing tomorrow, it's going to take a month just for that facility to ramp up to capacity.
Yeah, let me just cover just a couple data points in here so people can understand the scope of this. That facility, the Ras Laffan facility, which takes gas out of the North Field, which sits directly between Qatar and Iran. That facility produces at max capacity something like 70 million tons of gas every year, which is 20%, of LNG, which is 20% of the world's supply. So huge. A disruption to that facility is very significant.
Yeah, and so what you're already seeing is that, so Europe is one of the major importers of the gas that comes out of that facility and other places in the Middle East, because they decided, the brilliant decision to choke off supplies from their really long-term low-cost supplier of Russia back in 2022, and as a result of the Russia-Ukraine conflict. And so they were able to kind of plug the gap in losing their biggest supplier of cheap pipeline gas from Russia with these LNG imports. But the problem is, now they're reliant on the next geopolitical hotspot that's flared up. And so by losing access to those LNG imports from now the Middle East, the total European gas inventories have been drawn down to their lowest levels since the previous 2022 conflict. And they're going to be racing all year to refill that storage just to avoid a crippling, devastating winter where they could potentially run out of gas, or at least be paying just through the nose to basically fight for the remaining cargoes that are left on the global market. And, they're going to be fighting against China and Japan and Korea to take up these, the minimal amount of supplies that are available.
Also, Ross, let's not forget that someone, we can't imagine who, blew up Putin's major gas pipeline to Europe.
Right.
So you have had some once in a century kind of disruptions to the energy markets that have unfolded. The blowing up of that pipeline, the war in Ukraine, and now the destruction of a part of the Ras Laffan field, destruction of the East-West crude pipeline in Saudi Arabia. You've had some really rare events all happening at around the same time. I mean, the span of the last 3 or 4 years. And so I think this sets the stage for, a pretty good period, maybe a 4 to 6 year period of sustained higher energy prices, with a focal probably being on LNG.
Yep, exactly. And at the same time, the benefit of the U.S. shale revolution, it's kind of the gift that keeps giving, because we just have so much cheap, abundant gas here. When you have prices that are right now $15 an MCF in Europe and Asia, and they were as high as in the 20s or 30s before this, we've had a little bit of a correction in the price. But America's now paying $2.60 an MCF, and that's kind of a 52-week low in the gas price, because
it's like a tenth of the global price.
Right. And so what the real opportunity here is any companies that there's an arbitrage to take cheap U.S. shale gas that's in abundant supply and export it globally, whether it's LNG, and there's also the fertilizer trade, which is kind of a derivative that is maybe a separate topic, but it's created this boon for certain U.S. industrial companies that use cheap feedstock gas, whether it's in fertilizers or LNG, and can sell it at very high prices overseas.
So let's talk about the 3 or 4 main beneficiaries of this dramatic arbitrage between U.S. domestic natural gas prices and global energy prices that are products that are derived from natural gas. Because there's things I think people are going to overlook. The most obvious one, we're talking about that today. We're talking about LNG. Well, that's simple. It's just natural gas in a compressed form. It's the same exact product. But there are other products too. For example, fertilizer. The main ingredient in nitrogen fertilizers is going to be natural gas. That's where the nitrogen's coming from. Mm-hmm. Then you've got all kinds of petrochemical products, essentially plastics of all types.
Yeah.
And then I think the third, and I haven't heard anyone talking about this yet, so this is a little bonus for the Black Label folks, is think about other forms of wet gas that come from the Permian, and a company called Targa that exports them and has huge propane export terminals. So one of the ways that Europe and other places will replace the missing LNG is going to be with propane and butane. And that's coming from Targa. But for this call, we just really want to focus on LNG, and if we can swing back around to Venture Global, and I'll lead us off. Venture Global came to my attention because it IPO'd in 2025. Ross, or am I conflating? Was it 2024?
I believe it was 2025. Let me just check here.
So this was a big IPO last year, and I've been very bullish on U.S. energy exports for a long time. Aaron, when you first started working with me, that's when I was writing this report called All the Oil in Texas, and this was 2010, 2011 timeframe, Ross. And I was telling everybody, forget about peak oil. We have discovered 20 Persian Gulfs in Texas, and no one cares yet. And I know you thought I was crazy.
Well, I remember it was the first week, and you sat me down and you said, look, I want to write this package. And it's, obviously it's always based on your research, and you're kind of ahead of the curve. And I think the barrel of oil was probably 120, 130, 140, and everybody was calling for peak oil. That's it. The world is out of it. And you're like, they are so stupid. They can't see it. There's so much we're swimming in it. And we've got these things called horizontal drilling and fracking. And I'm like, huh? And you're like, by the way, here's a book. Go read Jurgen's book. And also here's some reports. And you said and predicted that the United States would lead not only in production, but also export. And we would surpass Saudi Arabia, and we surpassed Russia.
Yep.
That's exactly what we did.
That's exactly right. So when we started on this research project, when first understanding what the Permian was in particular, America's oil production had gotten down to 5 million barrels a day back in 2006. And, since then it's now grown fourfold, right? Because we're approaching 20 million barrels a day oil energy equivalent production. And America is now the largest energy exporter in the world. And when we started writing about this, no one thought it was possible. They thought we were going to go into peak oil. So Target was a recommendation I first made back in 2012 for the same exact reasons. At the time, it was illegal to export crude oil from the United States. So propane was one of the few ways you could get energy into the global markets. And that was even before Cheniere began exporting LNG. They were in the process of starting that. So recommended LNG through Cheniere and recommended propane through Targa. And those picks, as you know, have done outstanding. Mm-hmm. That was when we first recommended Texas Pacific, which has just been a home run since 2012, up a couple 1,000%. So we have some background understanding the value of low-cost American energy on the world markets. And so when I saw Venture Global come public last year, I thought, oh, man, this is right up my alley. We know a little bit about this. And then when we saw the executives buying the stock around $7 or $8 after their IPO, that was also a big tell. So there are a couple of warts on the stock, but let me tell you how it got started. There are these two pretty unlikely entrepreneurs, Mike Sable, who was been a longtime investment banker, and a guy named Bob Pender, who's kind of an iconoclast. He's a D.C. Washington lawyer, not exactly who you'd expect to be launching an energy business. But a long time ago, they had a friend of theirs who was Sri Lankan, and he was telling them that the civil war in Sri Lanka was ending and that the country was desperate for more energy infrastructure. And so back in 2009, they flew to Sri Lanka at the end of the Civil War, and they were scouting out where they could build a new coal-fired power plant in Sri Lanka. Long story, that deal didn't come to pass because once they got to Sri Lanka and they looked around, they realized that what Sri Lanka needed wasn't a coal-fired power plant. What Sri Lanka needed was way more natural gas for its existing natural gas infrastructure, because that's what people are using to cook in their homes, and that's what people are using to run their generators. And they didn't really have much of an electrical grid, but they did have natural gas pipeline. And that is something you find in a lot of different markets. Most notably, I would say, is Spain. But I've seen that around the world, that there's usually gas for cooking. And that, of course, gives you the base infrastructure for routing power around too, which is why LNG is such a good fuel source. So they came back to the United States and they realized the Permian boom was happening, and they saw an opportunity, and so they shifted. And instead of trying to build an LNG facility in Sri Lanka, they decided to create the best, largest LNG export facility in America. And their key innovation, Ross, and I'd like for you to help describe this to us, is what they figured out is instead of building it on site, if they instead built all the pieces in a factory, they could just assemble them on site like a Lego block. And that would give them a tighter timetable and far more control over their costs. Can you tell us more about that, Ross?
Yeah, exactly. I mean, it's such a game-changing innovation, because when you think about an LNG facility, these are some of the most complex and costly, time-consuming industrial projects in the world. And we just kind of talked about the Ras Laffan facility. I mean, it's going to take 3 to 5 years to fix 17% damage to that facility. And that just kind of gives you an idea. These are multi-year, multi-billion-dollar projects. And the old school way of doing it, the way that everyone had done it up until these two guys came up with this new innovative approach, was every facility is custom built you start with a blank piece of land and you have your blueprints, and you showed up to site and you're kind of building everything from the ground up as a whole new custom facility. And the way I kind of like to think about that is maybe a useful analogy is I had to build a fence. Me and my older brother decided to build a fence for my mom for Mother's Day a couple years ago. And, neither one of us have much experience building fences, but we know our way around power tools, right? I spend most of my day
Two
behind a
high
computer.
IQ analysts building a fence. Hilarity,
seems like
hilarity
good use of your
ensues.
time.
Right. So I thought I was smart about it. I went the weekend before, went and did all my measurements, had this nice, beautiful plan all sketched out. And then, we order the stuff and show up the following weekend. And immediately when you start actually putting the pieces together, things start going wrong, right? Like the spacing was off. We realized that we're digging these holes to cement the posts in, and they're not lining up exactly right. And so we have to start, changing the pieces around, making multiple trips back to Home Depot. And it just turns into basically a weekend long disaster. And I think if I were to, right. And even though you've got these very experienced engineers that are building these complex facilities, they're, when they show up to a site, things just go wrong. And this is anyone who's tried to ever do a custom project in their backyard has probably experienced this at some point. All the plans you had when you got there, something changes, something breaks. You got to start making trips back to Home Depot.
I remember when I was in high school, my brother and I got one of those aluminum sheds from Sears, and you put it together at your house, right? And there's like 1,000 pieces of this thing. My brother is now a very senior mechanical engineer for the GE. He builds these enormous turbines. So, he's in charge of this project. And I made a bet with him. I said, when you get done, how many parts are you going to have left? Is the over-under more or less than 10? And sure enough, when he got finished, there was like 7 bolts or whatever. I wonder why we have this left over. But anyways, this is exactly right. They call this stick building. When you build with sticks, meaning you build custom on-site, the amount of complexity is really impossible to predict. It's kind of like the weather. It's too complex of a task. There's always going to be changes. There's always going to be problems, and it takes a lot longer and costs a lot more than you might expect. Meanwhile, using this new kind of construction method where they built everything in a controlled environment and a factory and then just assembled it on site, they were able to get their construction costs down to about $1,000 per ton of annual LNG capacity. And that's the same price, by the way, that Ras Laffan was built for on a much larger scale by a workforce of, let's call them ununionized Filipinos. So this new innovation has allowed them to build in America at the same low cost as their competitor around the world, which is a really, really big innovation. They've also been able to deliver on time and on budget, which is something that no one had ever been able to do before. So these are really cool things. And then you have to understand the scale of what they're, in terms of growing their earnings, the scale of what they're doing. So their very first facility, which is fully online now, I'm going to mispronounce this. It's called Calcasieu Pass. And I don't know why, but my mouth wants to say that, Calcasieu Pass. And that has 10 million tons per annum of capacity. Their Plaquemine facility, which is in final permitting or final trial run stages now, will be fully online by the end of this year. That's twice the size of it. That's 20 million tons of annual capacity. And then their third thing, CP2, that site is going to be coming online in 2027, fully online probably by 2029, and that is another 20 million ton project. So this company over the next few years, say by 2030 certainly, is going to go from producing probably this year probably around 30 million tons this year, all the way up to 50 million tons. And that's really significant growth. And by the time they're finished, this will be the largest U.S. producer of LNG.
Yeah, they're on pace to overtake Cheniere by 2030, which is going to be huge considering that they started from, I think, a 5-year lag versus when Cheniere finally started to transform their business model from imports to exports. But just to go back on these amazing cost savings and the speed of which they can build these facilities. One of the key data points to this was that when they built that first facility, the Calcasieu Pass, that was a record setting completion time in the US. They built that 10 million per ton facility in just 30 months. And for perspective, Cheniere is the number one. They're widely respected as the most efficient. I think every project that they've ever built has come in under budget and quicker than they anticipated. And for their similar kind of Sabine Pass and Corpus Christi facilities, those took 42 to 45 months. So you're talking about a 50% reduction in time to market. And the even more amazing thing is that when they built the Bakker Mines facility, which is twice the size, they also completed that in the same 30-month time period. And that just goes to show you the advantage of this modular approach, where they're taking a pre-built, all of the hard construction work to build the liquefaction trains is built in Italy. They're built to spec, and they just ship them over, and it's just plug and play. And the fact that you can go from the investment decision being made to a full operating facility in 30 months is just unheard of. And the fact that they can do it that same timeline for a facility twice as big is even more impressive, because it just shows that this business model truly scales.
Yeah.
And it's just amazing.
So one big knock on the stock, and this took the stock from an IPO price of $25 a share all the way down to the lows, maybe $5 or so, $5 or $6, Ross. I have that right?
Yeah.
And we were able to make this a best buy in our recommended portfolio in January at around $7 a share. So stock is now trading between $12 and $15 a share. So it's gone up since our best buy, but as I think you'll see when we get finished with this conversation, stock's still really cheap. So it went public at a $25 share price, got all the way down to $5. We've started recommending it. People have done well so far. But why would the stock go from 25 to 5? And the reason is because these guys, they play it a little fast and loose with their idea of a contract. So when they got started with their very first facility, the Calcu Pass, I can't pronounce that word, the
Calcasieu
Pass. Thank you, Ross. they had this period of time what they called commissioning, and in their contracts it said that they sell these long-term supply contracts at fixed prices. So look, for 20 years, you're going to take or pay me for my gas, and it's going to be, between this price and that price, and we have a contract, and I deliver it, and you take it. But I've got this period of time called commissioning where I'm not quite sure I can deliver, because I'm not sure all my systems are going to work. I got to make sure they're totally up to speed before I can say, yeah, I guarantee I can deliver. So there's this commissioning window, and in these contracts, that commissioning window is a little unclear.
Right.
And so when the Ukrainian war broke out and natural gas prices spiked heavily, what Venture Global did was, instead of honoring their long-term contracts for delivery at a fixed price, they said, sorry guys, we're still commissioning. We're going to sell all these cargoes to Asia where we can get 4 or 5 times higher prices. And Venture Global made $8 or $10 billion doing this. They made a lot of money, but instead of honoring the long-term contracts, going to the spot market and selling at a higher price. Not surprisingly, their long-term contract people, Shell, Repsol, British Petroleum, Edison, they all declared foul, and they sued them. And they sued them for big, big bucks. And so these various lawsuits have been working their way through the courts, and investors were very concerned because Venture Global has borrowed so much capital to build all these plants that if they lost these lawsuits, that it could end up in the bankruptcy of the company. And so that was what happened to the stock price. So what happened to the lawsuits? Well, Shell lost. They went to arbitration, and Shell lost. Venture Global won. Shell tried to overturn the arbitration decision in a federal court, and the judge rejected that attempt in March of this year, so just last month. So that case is now fully over. Repsol, same thing. Venture Global won. The tribunal ruled for the company, and they said that Venture Global acted reasonably, and it even awarded Venture Global the legal fees that they had to pay to defend themselves against the Repsol lawsuit. So that's like a win with a star. The BP case didn't go that well. Same fact pattern, same things, but in this case, BP won the liability phase, and they got a judgment for $3.7 billion in damages. And that now Venture Global is appealing those damages, and that case probably won't be settled or finished until 2027. The other cases are all being settled because the other plaintiffs realized they probably weren't going to win. And so they've been settled for, various small things, like Edison, for example, got some extra LNG cargoes in a settlement. Not a big deal to Venture Global. So the risk here is $3.7 billion. I don't think that's very material, even for a company at this age and scale, which is still just beginning, because of the value that the LNG cargoes are earning currently. So I think it's very likely that BP and Venture Global will just settle. They'll come to some new agreement or something, but I think it's unlikely either way. Even if it's a $3.7 billion cash payment, I don't think it's going to affect the share price going forward.
Yep, I agree with you there.
Let me ask you a question, if you don't mind. It seems like there was a precedence set with the other companies in being dismissed, and in BP, was it a different circumstance, do you know? Or is it a different judge? Is it a different jurisdiction? Like, that seems so odd to me that these other companies couldn't get anything done, and even their legal fees paid, and then BP gets, a $3.7 billion.
That goes to a level of detail of research that I haven't done. You'd have to go read all the different cases.
Yeah, it just seems so
You'd have
odd,
to go read
right?
all the different cases.
The one thing I've read about it there's the details are obviously confidential, but there's various like lawyerly publications that write about this kind of stuff. And my understanding is that Shell made the mistake of trying to argue the actual contract terms. And of course, one of the founders was a lawyer who put these together. And so that was just a poor angle to take. Whereas BP, their focus was not the details of the contract, but the fact that they didn't honor it to the letter of, they didn't argue the letter of the law, they argued more the intent. And they said that you could have basically sped up your commissioning phase, but you didn't. And even though you were technically allowed to under some minute contract definitions, you didn't honor the spirit of the law, kind of thing, if that makes sense.
They have better lawyers.
Right.
I think what it comes down to is they had better lawyers.
That's what it gets out. That's
and
the
also,
answer.
the other thing it comes down to, Aaron, is what's the one thing you'll never find in a courtroom?
A fair
Justice.
trial. Justice, exactly.
So it's always just a crapshoot.
Right,
when you go to these
All right, thanks for explaining. I was a little confused.
So let me just give you a little rundown why I think this is not material, even though it sounds like a lot of money. It's not material because just 2 weeks ago, Venture Global closed a new $1.7 billion term loan. Okay, a bank's not lending them another $1.7 billion if there's any risk that this lawsuit is a threat to their balance sheet. On the balance sheet currently, they've got $2.5 billion in cash and they hold $35 billion in debt. And sure, that sounds like a lot of money in debt. I get that. I understand. But hang on. That debt isn't coming due in any size or scope until 2029. So they've got plenty of time to refinance. They've got plenty of time to go do another equity raise if they need to. And in the meantime, their capacity is growing from 10 million. What is it? What's the measurement? MTPA. Per year to 50. So they're going to have very big cash flows. And let me talk more about that. Their EBITDA in 2025, right, with only about a third of their capacity online, was $6.3 billion. So they made over $6 billion in cash last year. This year, they have 70% of their production currently under long-term contract. They have 30% of their production available for spot market, and they're in commissioning.
That's big.
So you don't know how much of that long-term contract is going to be honored and how much they're going to go out to the spot market. What I'm suggesting is on May 12th, when they report earnings, I'm suggesting that earnings are going to be a lot stronger than expected because of the very high spot market prices that exist and their proven historic ability to go out and get the spot market.
Yep.
You have any thought about that, Ross?
Yeah, I think that's right. So I was just looking at the estimates for this year before our call, and the analysts have penciled in $8 billion this year.
And EBITDA.
In EBITDA, yep.
Yeah, that's considerable growth from last year.
Yeah, and I think there's a lot of hesitance among the analyst community to bake in that this energy price shock is going to last, because you can kind of play around with the numbers and it's a huge difference. So just to kind of put some numbers on it, when you have those contracts, those are basically a fixed $2 per MCF fee that they're getting. And that's about 70% of the volumes, as you mentioned. For the other 30%, you have completely open exposure between what your current LNG feed gas cost is, which is around $2.60 currently, and the spread overseas, whether you're going to Europe or Asia, it's about $15 per MCF right now. And so that's about $12 an MCF versus $2. And so basically for every dollar increase above the $2 spot price that they're getting on their fixed fees, that's about $600 million in incremental EBITDA. And I think the assumption kind of baked in is that they're going to have about a $6 spread over the course of this whole year. But if that ends up being something like 7, 8, 9, 10, maybe as much as 12 or maybe more, who knows how this conflict goes. I mean, you could be seeing a very similar situation that we saw in 2022, where it's just an absolute windfall. So the 8 billion, I think, is conservative. And if this conflict lasts for more than maybe, if we don't get a ceasefire deal in the next month, and there's this persistent high price overseas versus, I think we can be pretty confident gas is going to be low this year, because we just have bloated storage inventories and production is ramping up. I mean, you could easily see a situation where they make 9, 10, maybe more $billion this year alone, which would be huge.
Yeah, and what I like about this trade is, even if that doesn't happen, even if the global price of natural gas doesn't stay elevated, even if they don't get any spot market cargoes, which we know they'll have some, even if they don't get any of that, let me just do some basic math for you right now. Okay, so these plants all have a 30-year lifespan. So if you look out over the next 30 years, you can know, because of the construction timetables and how good they are at executing, that Venture Global is going to produce something around 1.4 billion tons of LNG over the next 30 years. And if you just use the current prices, that's $580 per ton, that generates $780 billion in gross revenue over the life of these projects. Now, with even a little bit of inflation, that gets you to $1 trillion. But we're not factoring in any higher prices at all, which there will be. So this is just assuming everything stays the same as today. So after all the operating costs and taxes, that means that Venture Global is going to generate around $300 billion in after-tax cash flows over the next 30 years with their existing infrastructure once it's completed. So that's why I'm not worried about a $3 billion lawsuit. Yeah. It's 1% of their known profits over the next 30 years with its infrastructure. And I know probably somebody's saying, 30 years, how can you know in 30 years we're still going to be using natural gas? Well, because we've been using oil as an energy source, as a primary energy source since about 1870. I don't think that's going to change in the next 30 years at all. In fact, I think we're going to use a lot more LNG, and I think they're going to get higher prices, and of course there's going to be inflation. So these numbers are extremely conservative. But if you back out using a 10% discount rate, you back all that out with the share count, etc., then you get to about $30 in value per share. So if you buy at 15, then you're looking at, sorry, I'm completely messing up this for you. Let me just back up. After operating costs and taxes, the company's going to generate around $300 billion in after-tax cash flow over 30 years. The net present value at a 10% discount rate of those future profits today, again, using a 10% discount rate, is roughly $80 billion. So the value of that $30 billion and the value of that $300 billion in 30 years is $80 billion today, and that translates to about $30 per share. Wow. So in other words, at a 10% compounding rate, the stock is worth $30 per share today. So if you're buying at a discount to half of that price, say $15, you're setting yourself up to compound that capital at 20% a year for a very long time. And what I think is a core civilizational level infrastructure piece. I think it's very unlikely that Venture Global's facilities are going to go bankrupt, and I think it's virtually impossible that they won't be utilized to full capacity. So I think this is, in a way, it's almost like buying a bond, but instead of making 5% a year or 7% a year, it's a bond that's going to pay you 20% a year. And again, all that math is based on current LNG prices. No price spike for the next decade from Persian Gulf craziness. No other upside. And so I really like that. If my downside is making 20% a year and my upside is making 3 or 4 times my money in the next 12 months, I'm in.
Yeah, I think that's a great way to frame it. And what I do love about this is I do think you can think about it as a bond. And the nice thing is it's a bond that's sort of long geopolitical volatility and long inflation, Whereas most bonds, if you look like in the last oil shock we had was in the 70s, and bonds just got decimated because it led to the inflationary outbreak, and it was just a horrible time to be a fixed income investor. But in this situation, you have something where, like you said, Porter, if it's just business as usual, there's no more chaos in the Middle East, and Europe doesn't go crazy and decide to alienate their next major gas supplier, whoever that ends up being, and there's just peace globally, it's still going to work out to be a tremendous way to capitalize on what's always going to be, I think, for the foreseeable future, cheap gas in America and just modestly more expensive gas overseas. So I think I've kind of baked in like a $6 spread between where U.S. prices trade versus overseas. That's something like $3 to $4 U.S. gas prices and $9 to $10 in Europe and Asia on average, which is kind of where we were for the prior decade before all this geopolitical chaos happened over the last few years. And even with that, I have kind of the same outlook you have, which is the business should be able to make about $11 billion in operating income by 2030 as these plants ramp up. And so I get to assume they put on about a few, I think I have an estimate of they're going to have to raise a little bit of debt. So they'll have maybe 50 billion in debt by that point. And you put a $12 multiple on their enterprise value, you get about 132 billion in enterprise. And that gives you an equity value of 82 billion. And so that works out to like a mid-30s share price by 2030. But again, the big benefit here is that if there is more geopolitical chaos and they do have a few years here and there, maybe it's this year, maybe it's 2 or 3 years down the road, where instead of making $6, $7, or $8 billion, they have a few years where they're making 10 or 12. You just have that implicit kind of free call option of whatever, if there's chaos in the world, it's going to probably hurt. I mean, we just saw in the last month how bad stocks got hit when it looked like the situation was going to escalate. And this was sort of one of those safe havens that was one of the ways that it's a good underlying business model, but it has that upside if chaos breaks out over the rest of the world.
That's right. That's pretty good. Well, Ross, I want to thank you for joining us. Brabsy, what do you think? Is this good enough for your capital?
Yeah, and as being like, I know this drives you guys crazy, right? So you got like TPL. TPL's not a cheap nominal stock price.
No.
This today, I looked it up before we got on air, and today is the 16th of April, and it's like $12.25.
Yeah.
Right. So of course, I'm thinking not in terms of what you guys think of, but I'm thinking, how many shares could I buy at that price? Right. So is it attractive? Yes, this is very attractive. And, I want to point out too, that if you're a new listener and you're not a subscriber, this is the type of research we put out, and it's deep research. It's not just choosing stocks and putting them out there. We put the whole story behind it, analyze everything. And I'm very excited about this.
And by the way, let me have full disclosure here. I own 100,000 shares of Venture Global.
So you like it?
And the stock's at 50 cents today, which means I'm up 50 grand today.
Okay, it's a good day.
So yeah, it's a good day. I'm not. I didn't buy it because I think it's going to do well tomorrow.
Right.
I bought it because I think it's a very safe way to compound a lot of capital for the next decade.
Now, as you said, 20% a year. Where are you going to get that?
You're not going to get it anywhere else
with
that's
very
comparably as safe.
Yep. Absolutely. Thank you, Ross, for joining us. And by the way, just FYI, don't kill me, YouTube, because I know that, I'm the marketing guy and you guys are the analysts, and sometimes you don't like when I offer kind of discounted deals. But we do have our complete investor, which is $1,425 a year. However, for this show, and I'm going to give a specific domain out, it's called porterscompleteinvestor.com. porterscompleteinvestor.com. We'll give our entire portfolio of picks for a quarterly price of $400.
All right. Sounds good. Sounds like a fair deal. And I think that way, if you have an investment portfolio of 50 grand or more, paying that kind of price for great research that gets you a portfolio that'll do 20% a year seems like a fair deal to me.
It seems like a very fair deal. So, Ross, thank you so much. We appreciate it, and keep that AC cranking. Good news is you're in Houston. You have unlimited energy down there, buddy. You're going to be fine.
That's right. We are swimming in natural gas down here. So yeah, thank you guys. Great conversation, and thanks for having me.
All right, Ross, we'll see you soon.
See you, man.
Always a joy to have Ross on.
Yeah, he's a great analyst.
So smart.
I think it was so interesting that your comment was, it's good enough for my capital, and I like it because it has a low nominal share price.
Yeah. I mean,
just the emotion of that, you can't overcome it with any kind of facts or logic.
I know, and that's one of the first things that you taught me when I first joined you in 2010, and you explained it, and I was like, yeah, but those cheap stocks are like attractive. You're like, define cheap.
Yeah.
Yeah. Usually those cheap ones are really expensive when it comes to
earnings,
sales. Exactly.
Revenues,
So yeah, 100%. But no, that was great. That was a great talk.
The last thing about this I'll say is, I really believe this is a blue chip business. Now, it's not today.
Right.
It's a speculative grade credit. I mean, there's some issues, it has these legal liabilities, but what they have built is a blue chip piece of infrastructure. And honestly, I wouldn't be surprised if long before 30 years is up, a major integrated oil and gas company, Exxon, comes along and just buys it. So I think you have a really limited downside here, even in a worst case scenario. Stocks trading below 10 or 8 or 9 or $8, it's going to be a really attractive acquisition target. So there's just a lot of things to like about the situation. Very asymmetric, where there's a lot of upside and there's not much, if any, downside.
Let me ask you this. So, I live in Colombia. Everything runs on gas. I mean, there's a lot of gas in Colombia itself, but we cook on gas and all that. What was it, because America was built more on electricity before they were pulling gas out to not have gas stoves, gas cooking? Like,
I
there's
think
a lot more electric.
I think it just really depends on where you are. So one of the oldest stocks in the New York Stock Exchange is a company that first built the gas system in Pittsburgh. Why they built the gas system in Pittsburgh in the 1870s? Well, because they had the gas fields right there.
Right.
So it all just really depends on where you are.
It's a location if they were gas fields. Yeah, because back then you're not going to put pipelines. It's just you're going to pull it out for use wherever you live. So
yeah, and then there are some cities where gas infrastructure was a major selling point for development. So there are places that have it, there's places that don't.
Cooking with gas is superior.
The best.
Period.
Yeah.
Like,
I think the same thing about dryers for your clothes.
Yes.
If you have a gas powered dryer, it's gonna get your clothes a lot drier.
A lot drier. Yeah. Yes. It takes the humidity out, which is nice. Okay, great. Well, Porter, we always do love feedback. And let me give that long, drawn out email. You got to really earn it, guys. You got to earn it if you.
Do we get any feedback from?
We do.
People, is there any proof that people can use this email?
I mean, honestly, like hardly at all. However, if Porter gets too loose with some topic that Jimmy somehow let slip through the editing cracks, then we get feedback. Right? We haven't had anything that exciting lately. I think we're trying to keep ourselves out of trouble or something. I'm not really sure. Or maybe it's because we don't have gin and tonics.
I think it's probably the lack of booze.
I think it's a lack of gin and tonics. Yeah, that's the
all right. What do we got? People who want to send in something say we're wrong. They think they think they know more than we do about venture global.
Which I like. Yeah, that's fine.
Great. We'd love to hear it. Tell us.
Feedback at porterandcompanyresearch.com. Feedback.
That's not too bad. Feedback at
porterandcompanyresearch.com.
And is spelled out A-N-D.
That's right.
porterandcompanyresearch.com. Feedback
That's it.
at porterandcompanyresearch.com.
Yep.
Do we have some feedback?
No feedback today.
Feedback today.
We haven't gotten feedback in a while.
Let us hear from you, folks. We're getting lonely over here on the feedback email box.
And also, one more thing, guys. If you're not on the Daily Journal, which you've written about a lot for all these topics, and it's probably the second best in the industry behind Bill Bonner.
That's a good compliment.
The Daily Journal, right? So you can go to portersjournal.com. portersjournal.com. Give us your email address, and
you can sign up for free.
We deliver that right to your email box every day.
Great.
All right, guys.
Thank you. Thanks, Aaron. Appreciate you coming and doing this, and nice to see everybody again. We'll see you soon.
Thank you for listening to the Porter & Company Black Label Podcast with your hosts, Porter Stansberry and Aaron Brabham. We'll see you soon.